Hi all, welcome to this session. In this today's session, we are going to understand how the different financial statements connected together. In the previous discussions, we already covered the key financial statements like the income statement, balance sheet, statement of cash flow, and statement of changes in equity. So now we are going to see how these 3 or 4 important financial statements are interconnected together and how this will help to how this concept will help in the real business making, decision making process. The key learning objectives of today's discussion is explain how net income flow into the balance sheet. How the net income is flowing into the balance sheet, and explain how cash flow statement reconcile with the balance sheet. We have a cash balance, ending cash balance in the cash flow statement. How this ending cash flow statement is connected with the balance sheet. Identify the relationship between all 4 financial statements, that is income statement, balance sheet, statement of cash flow, and statement of changes in equity. Interpret the effect of transaction on multiple statements. How one single transaction is affecting in multiple financial statements. Apply linkage concept in real business decision making process. So these are the key learning objectives for this discussion. So let's move directly into discussion. Before moving to the linkages, we have to just review that what is each financial statement. The income statement is measure profitability over a period. Balance sheet show the financial position at a point of time, and cash flow statement changes cash during the period, from where the cash come and how the cash go out. And the statement of changes in equity is take the movement of equity. What is the opening equity, what are the changes in equity, and what is the closing equity. The key concept of today's lesson is all statements are interconnected, and changes in one statement will affect other also. If there is some changes in the income statement which is going to affect in the balance sheet, there is some changes in the balance sheet, or there is some changes in the cash flow statement which is going to affect the balance sheet, and all these statement changes, especially the income statement changes, all definitely will going to affect in the statement of changes in equity as well. So the key concept of today's discussion is to understand that how these statements are interconnected and on which point the each statements are interconnected. The first key linkage is net income to retained earnings. Ending retained earnings equal to beginning retained earnings plus net income minus dividend. The retained earnings is a portion of owner's equity in the balance sheet, while changes in the net income and dividend both are affecting the retained earnings. If the company generated more profit and more net income, it will increase the retained earnings, and is there any dividend paid which will reduce the retained earnings also. So here the connection is the ending retained. To calculate the ending retained earnings, you have to add up net income and minus the dividend with the beginning retained earnings. Net income from income statement increase retained earnings in the balance sheet. If the net income increase in the income statement, which will automatically increase the retained earnings in the balance sheet. And is there any dividend paid? Dividend payment is affected in the cash flow statement, and which will decrease the retained earnings. So these are the 2 key links related to retained earnings. If the net income is increased in the income statement, which is automatically reflect in the balance sheet also. The other thing, is there any dividend paid which will reduce the retained earnings. You can see an example here. In this case, the beginning retained earnings is 50,000 and net income 40,000, and the dividend paid is 10,000. In this case, ending retained earnings is 50,000 plus 40,000 minus 10,000 is equal to 80,000 is the ending retained earnings in this case. So in this ending retained earnings, the net income and dividend both are adjusted with the beginning retained earnings. So let's move into second connection, that is balance sheet to cash flow statement. How balance sheet and cash flow statements are interconnected. The key linkage is ending cash balance is beginning cash in the balance sheet plus net cash flow from the cash flow statement. If the net cash flow increased, ending cash flow in the balance sheet also get increased. If the net cash flow decrease, the same effect in the balance sheet also. The ending cash balance will decrease. The cash flow statement, as we discussed before, we have classified all activities into three: operating, investing and financing activities. You can see this example. The beginning cash is 30,000 and net cash flow from all the activities is 25,000. In this case, the ending cash balance is 30,000 plus 25,000 is 55,000 is the ending cash balance in this case. If the net cash flow from all activities get increased, which will automatically impact the cash balance in the balance sheet as well. Now we are going to discuss a single transaction impact in the multiple financial statement. Suppose let's take an example: purchase of equipment with cash. If we purchase an equipment with the cash, the income statement, there is no immediate effect with this transaction unless depreciation applies. If there is no depreciation applied in the first year, there is no immediate effect in the income statement if we purchase equipment with the cash. In the balance sheet, there is a changes in the asset side. Equipment will increase in the asset side. At the same time, the cash will decrease from the asset side. So both impact in the asset side only. One asset will increase, that is equipment will increase, and cash will get decreased. In the cash flow statement, cash outflow in the investing activities, because the investing in equipment is an investing activities, so it will create a cash outflow in the investing activities. Now we will move into second transaction, borrowing from a bank. If we borrow money from a bank, the income statement, there is no immediate effect. If we borrow money from the bank, there is no immediate effect in the income statement unless we paid the interest. In the balance sheet, it will increase the cash. If we borrow money from the bank, it will increase the cash balance and increase the liability also. It will create same time parallelly a liability also in the balance sheet. So which will increase in the asset and increase in the liability. Cash also will increase and at the same time our liability side also get increased. Then in the cash flow statement, cash flow in financing activities. From the financing activity, there is a cash inflow will generate with this transaction. So let's move into the linkage with the statement of changes in equity. Statement of changes in equity explain the beginning equity plus the net income and subtract the dividend and adjust any other changes in the equity will end up with the ending equity. So it is showing the changes in the changes or reconciliation from beginning equity to ending equity. Here is the linkage summary table. The income statement. Net income flow to retained earnings. In the statement of cash flow, statement of changes in equity, the net income is flowing into retained earnings. So this will get effect in the statement of changes in equity. Then the balance sheet, ending balance sheet reflect net income, cash flow and equity changes. Is there any changes in the net income? It will get effect in the ending balances like retained earnings and cash flow and changes in and equity changes, which will get affected in the balance sheet as well. Then cash flow statement, which will explain changes in cash reported on the balance sheet. Cash flow statement will explain what are the changes from the beginning cash flow, beginning cash balance to ending cash balance. Then statement of changes in equity, which will explain how equity components change, including net income, how the equity component is changing, including the net income. Now we are moving to practical question, multiple choice questions. Just look into this case. The beginning cash is 20,000. Net cash from operations is 15,000. Invested 10,000 in equipment. Borrowed 5,000. What is the ending cash balance? To calculate the ending cash balance, you have to add beginning cash with the net cash from operations minus you have to reduce 10,000 as it is a cash outflow, and you have to add 5,000, that is a cash inflow from the investing activities. So in this case, the ending cash is 20,000 plus 15,000 minus 10,000 plus 5,000, that is 30,000 is the ending cash balance. To calculate the ending cash balance from the beginning cash balance, you have to add up all cash inflow and you have to reduce all cash outflow from the beginning cash balance. Let's move into second question. Net income is increase which balance sheet component? Cash, retained earnings, accounts payable and share capital. So it is retained earnings. If the net income is get increased, it will automatically increase the retained earnings in the balance sheet. So it is retained earnings. Let's move into question 3. A company borrows 50,000 from bank. Which statements are affected? In the balance sheet, it will automatically increase the cash and liabilities. And in the cash flow statement, the financing cash inflow will increase. In the income statement, there is no immediate effect until you pay the interest. So if you borrow from a bank, so the two statements getting affected, the balance sheet and cash flow statement, and there is no immediate effect in the income statement. So let's summarize today's discussion. What we discussed today is the linkages or how each statement is connected with the other financial statements. The income statement is connected with the retained earnings in the balance sheet. So just a quick summary of this discussion. The income statement is connected with the retained earnings in the balance sheet. Balance sheet is coming from the cash flow statement. Balance sheet also connected with the cash flow statement. Then the equity changes explain the statement of changes in equity. In statement of changes in equity explain how the equity changes during a period, or what is the reconciliation between the opening equity and the closing equity. The single transaction may be impact multiple statements simultaneously. We just discussed before the borrowing from a bank, which can impact in the balance sheet and the cash flow statement as well. That means a single transaction can have impact in the multiple financial statements simultaneously. Then the understanding linkage is crucial for financial analysis and CMA exam scenarios. To understand this linkage is very crucial for a financial management student and the CMA exam scenarios. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.